5 months into the year, and we still don't know which way the economy is really going. Hello, and thanks for checking out the fastest 4 minutes in finance for this week. I'm Scott Inman. As we enter June, the economic situation continues to be fluid in the U.S. The Federal Reserve's most recent rate hike in early May was initially thought to be its last of the cycle. But that has changed, as LPL Research now tells us the odds are at 60% that there will be another rate hike this month. One of the reasons is that some of the language from Fed members has suggested that inflation has not yet gotten under control. It seems demand has not cooled across all sectors of the economy, and consumer spending just keeps chugging along, up almost a full percentage point from the fourth quarter of 2022 to the first quarter of this year. So it continues to be difficult to slow this economy down. And we've talked in previous editions of the Fastest Four that credit card debt hit all-time highs earlier this year. That would suggest that spending would have to slow down soon as consumers max out limits and even fail to make payments. And that would be bad news for the economy. But there is a flip side to what's propping up consumer spending, and that's wage growth. Take a look at this graph from Statistica. It plots the year-over-year inflation rate compared to wage growth. And you can see that since inflation took off back in 2021, wage growth lagged behind. That is until February of this year. In that month, wages grew at 6.1% and inflation was at 6%. The gap widened in March, with wages growing at 6.4% and inflation cooling to 5% year over year. Of course, those are broad numbers, but it stands to reason that if a person's income grows faster than prices go up, they will be able to sustain their lifestyle. If Americans were able to do that as a whole, they keep corporations profitable, and that could avoid recession. But that's the economy. What's your economy? If you're still working, and will be for a long time, what's your plan to increase your income? Get a wage growth, in fact. If it hasn't happened at your existing job, is it time for a new one? If you're trying to achieve true financial independence, the graph highlights a key component to maintaining that financial independence. You have to plan to raise your income. Your retirement could last 30 years or more. You likely wouldn't work at the same job for 30 years without a pay raise, and you can't live on the same income for 30 years in retirement. You'll receive a cost of living adjustment from Social Security, but that won't be enough to overcome inflation. The solution is having a written plan that shows you the starting monthly income you can receive from the combination of your guaranteed income sources like Social Security and pensions and withdrawals from your investments, and a plan that illustrates annual increases to that income to keep you ahead of inflation. This would allow you to know if you're on track for true financial independence. If you need more income and you're still a few years out from retirement, you can increase your savings rate. If you're ready to leave your job now and need more income, this would help you determine what kind of part-time work you might need to supplement your retirement income. You can't control inflation, interest rates, or wage growth, but you can control how you plan for all three. And that can provide clarity for your economy, even when there is none, for the economy. Thanks for watching.